Okay, so let's get into it, like how the liquidity actually gets injected. So this is the U.S. Federal Reserve balance sheet, and we're talking about why Canadians should expect market volatility. And I start with the U.S. system, and some people might gloss over, like, you have to understand the world's reserve currency. You have to understand how that relates to the Canadian dollar. If you don't understand that in any market, you're going to miss the boat.
Yeah, they're the 80,000 pound elephant that we're all tied to at this point.
Yes, and I'll show you how it's tied to there too. Like I'll break it down how it's tied. But let's start here in the creation of the money. So this is the U.S. Federal Reserve balance sheet, and we all lived through the massive inflation that happened during COVID, primarily starting like right after 2020, and this is how it happens, the creation of money. And so we have that funny clip sometimes we play at the boot camp of Biden's economic advisor trying to explain how
well, the government prints money,
and they certainly lend money and borrow money. It's like, I don't understand it. Like this is here's what happens is the U.S. Federal Reserve actually prints money out of thin air, and they go out and they buy bonds. Okay, so they buy treasuries, they buy notes, they buy U.S. government bonds, they can buy mortgage-backed securities, okay, and ultimately they literally print money and they inject it into the system and take back those assets as collateral, and they end up on the balance sheet. And this is showing the U.S. Federal Reserve balance sheet. How did that money supply creation go on overdrive? It's like, it's not really just the $2,000 stimulus checks. If you add all that up, it won't equate to the increase in the money supply. It's like all of a sudden the U.S. Federal Reserve steps in here and they increase their balance sheet from $4.1 trillion to $8.9 trillion in the span of kind of, let's call it like 18 months.
So double.
Yeah, double.
That's a lot,
right? Yeah. And that that ends up injected into the system. So they're buying those bonds, injecting that liquidity into the system, and through the miracles of fractional reserve banking, that has a multiplier effect. That gets deposited to one account, and then someone's able to borrow against that, and they lend it to another bank, and they can borrow against that again. And so it doesn't go out on a one-for-one basis because of fractional reserve banking. It has a multiplier effect, okay? And ultimately, that translates into the expansion of the money supply. So it starts here, the Federal Reserve injecting liquidity, and all of a sudden you have this crazy uptick in the money supply in the U.S., where they go from $15 trillion to $21 trillion. Okay. So that is, how did this happen? It's like, that's how it happened. Okay. And what are the tools that central banks have at their disposal? There's primarily three tools. They talk about all their tools in their tool chests and make it sound very like cryptic and stuff. It's like, well, they can inject liquidity, okay? So they can print new fake money and they can buy back assets, which are predominantly bonds, okay? Or they can change the interest rates. They can raise or lower the interest rates, or they can adjust lending regulations and banking regulations and make it easier or harder to lend money. And that's really it, right? Like, that's what they're going to do to affect the money supply. And those are the three things, and they're all important, right? And so I think sometimes people look at just rates in isolation and think it's just rates. If the government keeps rates, even if they keep rates low, but they keep selling off securities, so they keep taking liquidity out, because when they sell off those securities, they collect that money back, and for all intents and purposes, that money gets taken out of circulation. It would still keep the money supply very low. Okay?
Yeah. Remember, like back in the 90s, I think it was the 90s, 2000s, whenever the Bushes were in, and we had Alan Greenspan, and I mean, we had some of the lowest interest rates in the U.S. for years and years and years, and everything was flying. People were borrowing. There was all kinds of money instruments going about. And then now we've got Jerome Powell, and after COVID, that's when we saw that jump from basically 0, 1, 2, 3% all the way up to 5, 6, 7%. Like, it's crazy, right? Yeah. So what's happening this year? Like, what's happening right now? We noticed the Fed moved their rate down a quarter point. Canada didn't really move. What's going on with Jerome Powell?
I'll show you why that relationship exists here, but it's important to understand this increase in the money supply. But then you have to understand what happened here. Okay, so we all talk about this, that there was an increase in the Federal Reserve balance sheet, but then they started quantitative tightening. And if you look here, like really the only other significant instance of quantitative tightening was, between, call it like 2017 and 2019. And just look at the degree of quantitative tightening. So this is basically the U.S. Federal Reserve allowing basically selling their instruments back out. So they sell their bonds or they let them roll off, and that cash comes back into the Federal Reserve, and it effectively just gets taken out of circulation. Okay, so this was, prior to COVID, this was the single biggest instance of any quantitative tightening ever performed, right? And they contracted the balance sheet from, call it 4.4 trillion to 3.7 trillion. Okay, this time they've contracted the balance sheet from 8.9 trillion down to 6.5. A major contraction in the U.S. Federal Reserve balance sheet. Okay, and that, you can see that in the money supply. So as crazy as the money supply expansion was in those 18 months, going from 15 trillion to 21 trillion, let's call it 22 pretty much at the top here. Okay. You go like 3 years later without any increase in the money supply. So you go from 2022 to 2025. So as wild as the expansion in the money supply was for 18 months, the 3 years after that were historically low. You've actually never even seen any sort of material decrease in the money supply until that point in time. Okay, you can see like that's the first real inflection point down in the U.S. M2 money supply, and only recently have we got to new highs over 22 trillion. Okay, so it's a major unprecedented expansion of the money supply, and then a major unprecedented contraction of the money supply. Now, the expansion was much greater than the contraction because we're already at new highs again. And you can see this trend line, like we don't come anywhere close. If you just draw a line in your head of where we were trending to, we're still, maybe call it $5 billion above probably where we would have been if that didn't, knock us off the trajectory. Okay, so that's a big deal, right? And people need to understand how tight it is. So when they're talking about asset prices, and they're talking about unemployment or earnings in the stock market or housing prices, they're often not talking about the underlying assets. Like, how easy is it to actually get credit, actually make those purchases when those companies go out and make capital expenditures and they hire people and and people start businesses. It's like it all relates back to that. Okay, trying to identify, if you want to see where unemployment is going, it's like, well, how easy is it to get capital to start something?
Yeah.
You know what I mean? How easy is it to get capital to start projects and build projects and businesses? It's like it all relates back to that. Okay.
And really it comes down to like, how much money do the banks have to lend out?
That's right. And even asset prices, people will think that, okay, asset prices, they're going to look primarily at unemployment. It's like, if you have Argentina style increase in the money supply, it wouldn't matter if you had double digit unemployment, asset prices would go through the roof, but they would go through the roof in nominal terms.
Yeah.
Okay. And so you need to start your discussion there. And I would say this is where this shouldn't matter this much, right? I can remember, attending university in the 90s and being absolutely bored with macroeconomics because things were relatively stable. But like imagine this time, right, where it's like things are like this, and I'm just like, it's just really, it's things around the fringes, right? It's 1 or 2% here or there, as opposed to now it's like it's the whole game. The term that's thrown around is fiscal dominance, right? Where it's like this matters more than the underlying fundamentals of the company sometimes, which is wild. Like that's not how it should be, but that's how it is, right? So if you're sitting there in Vancouver or Edmonton or Toronto or Calgary and you're trying to understand where real estate prices are going, start here. Start here. It's not that the migration patterns don't matter. It's not that the unemployment rates don't matter. It's just that this is the biggest factor in the equation and the most overlooked factor in the equation. You know, when have you ever talked to a real estate agent and, you know, it's like, where are real estate prices in Calgary going? I was like, well, the money supply, because of what the Bank of Canada is doing, is going. They'll never talk about this, even though it's such a big factor on where those nominal prices are going.
Well, I think most people don't correlate it, right? They don't correlate how much money, how much liquidity is being pumped into the system, making it available for banks to lend, right? And because of that, like, they're very short-sighted, and they look at just the rates. They look at just the rates. They look at inflows of people coming into the province or into the city. They're not really looking at the bigger picture. I mean, all those things matter, right? Like jobs, like people have to have jobs or they can't pay for a mortgage. But at the same time, if there's more liquidity in the market, if there's more money to borrow or more money to lend out, then businesses can grow, people can move in, people can get jobs, and they can afford their mortgages. So that's where it comes down to, how much liquidity is there. So printing money, basically.
Yeah, so when you see the comparisons in the real estate market and say, well, this is like the 90s, it's not like the 90s. This was the creation of the money supply in the 90s. This is where we are today in Crazy Town, okay? This is Crazy Town. This was the 90s, okay? You know, this was a very, in all intents and purposes, it was a fiscally responsible time. You had, believe it or not, you had, right-wing conspiracists like Jean Chrétien balancing the budget. Right? This happened. Like, it really, I'm old enough to remember that, right?
That was the only time in recent history we had a balanced budget.
It was a liberal, right? Like today, if anyone came up with a balanced budget, they would be an alt-right extremist, right? They'd throw them in jail. So we don't balance budgets, right? I think even Clinton balanced the budget in the 90s too, right? On the U.S. side, like, that really happened. And so when you're trying to make a comparison from this time period to that time period, but you're not taking into account the single biggest factor is you're measuring it in a unit of account, the dollars, but you don't know how many of those dollars are in existence and the rate of creation, okay? And if you look at it on the U.S. side, you end up with a number that's about 7.5%. Okay, you end up with an average increase in the M2 money supply since 1971, which is where this whole experiment began. You end up at about 7.5%, and so you see you see a much bigger increase in the money supply on average in the 70s and 80s. That was kind of the transitionary period into this system, and then after that, you see it maybe normalize a bit less. So maybe you could say maybe it's 7. Maybe you can make the argument that it's the average is 6.5 or something like that. Or if you just take the whole 53 years, you're at 7.5, right? But then you take into account these spike periods, and then you take into account the early transitionary periods where people think, oh, well, inflation and interest rates were so high in the 70s and 80s. That's because they introduced a new monetary regime and rapidly expanded the capital.
Yeah, I mean, everything turned into a credit economy, right?
Yes.
So everything turned into credit. So people were having charge accounts, credit cards.
Yes.
These things, that all happened, and then that's what kind of started the ball rolling on that.
Yeah, and it's hard to see here because this increase on a nominal basis is so small compared to today, but the increase here was actually very, very abrupt. So you see increase in the money supply in the 70s and 80s that run into double digits, just like you saw recently, like that, just like you saw during the COVID times.
Yeah,
right?
if you change the timeline on the map there, you'll find it. You would see that.
You'd see it, yeah. Okay, so that's the increase in the M2 money supply. Here are the rates, and here are the rates over the last 10 years. So the U.S. Fed fund rates, and they just dropped rates, was it yesterday or the day before? They give you that range, 3.5 to 3.75. Like the Bank of Canada at least just gives you a number, right? But whatever. So rates are coming down, but you look on a 10-year basis, this is actually still pretty high. It's actually still pretty restrictive when you're looking at it on an average basis. At the bootcamp, we break down the prime rates, and we look at what's the average prime rates over the last 25 years, right? Restrictive, but becoming less so, okay? And what stress that's had in the banking system. It's like, where does that, I'll give you, this is some ideas. Like, this is the U.S. reverse repo market. Okay. So this is the U.S. reverse repo market. And you can see, this is effectively, if you could think of it crudely, as the savings accounts of the U.S. banking system. Okay. When they have extra cash, what do? They give it back to the Federal Reserve and earn some interest on it, risk-free. Okay. So, and it tops out here in the money creation craziness of COVID of $2.5 trillion. Okay. And then you can see today, it's fully depleted. Okay. Let's say, they're going to call it $1 billion, $2 billion, but for all intents and purposes, it's empty. Okay. The savings account of the U.S. banking system is empty. They've lent out their capital. Okay. Which isn't that abnormal, actually. So if you expand this time period, there's a lot of periods where it's empty. But what's a little more concerning is this is the repo operations. This is the other side of the coin. So this is U.S. financial institutions, when they don't have enough liquidity, they can borrow from the Federal Reserve. Okay. And so if the last one was their savings account, this one is their overdraft. Okay. And this overdraft is set up for these institutions on a permanent basis now. It used to have to be specially approved, but now it's just set up on a permanent basis. And what you see here is, of course, it wasn't used at all for years because the banking system was absolutely flush with cash. Okay. They had so much that they were just giving it back into the reverse repo market. Okay. So it wasn't used for years. And you see these massive spikes, and almost like, you see this huge spike here where it's like, in excess of, it's almost $300 billion. That's an anomaly created by COVID here. That's an anomaly created by COVID. And I wish it didn't exist, because then this entire scale would exist at 100 billion, right? So basically off the charts, very temporary. They inject liquidity, they solve the problem. Now you get this over here, and this might seem rather, this is, current day. This is late 2025. This is September, October, November, December 2025. And you see a spike here to about $50 billion. Okay. So you see a spike to about $50 billion. That might, when you look at this chart here, it might not seem that spectacular, because you see this massive spike to almost $300 billion during COVID. But that was an exceptional time. And how did they solve that? The massive liquidity injection. But what I really want to point out was what happened at the end of 2019. This is the part that's buried in history because of what happened during COVID. Okay. If you go back all the way back here to this Federal Reserve balance sheet chart, and I said, before this time, this was the most significant quantitative tightening exercise in history, where from 2017 until 2019, they decreased the balance sheet from 4.4 trillion to 3.7 trillion. So $700 billion. They just took $700 billion off the table. It completely crashed the credit system. So this is the point that people don't understand, is this uptick here. And I love how they always say it's like quantitative easing and quantitative tightening. It's like you're not allowed to say the words anymore. It's like recession. Like it's like you got to have a committee agree a recession. We can't call it a recession just because it's 2 consecutive quarters of negative GDP. We got to talk about everyone's feelings in the room. It's whatever. Like balance sheet goes up, quantitative easing. Balance sheet goes down, quantitative tightening. It's like, I don't care. Call it whatever you want. Decreasing the balance sheet, increasing the balance sheet. But what happened was this QE, not QE. This was done on an emergency basis, because what happened here, if I go back to these repo operations, people forget that this is about $100 billion in late 2019. This actually, for all intents and purposes, started to crash the credit markets in the U.S. Like people were having credit cards canceled, HELOCs canceled, limits reduced, because they didn't have enough liquidity. Everyone forgot about this because of what happened next. So the U.S. Federal Reserve stepped in on an emergency basis and went from 3.7 trillion all the way up to, let's call it 4.2 trillion. They undid almost this, 2 years of work in just a couple of months, right?
Wow.
But everyone forgot that they did that because of what happened next.
Well, what was going on at that time? I don't recall. I mean, it's so far back, but why were they, reducing the money supply? What was going on at that point?
The thought was the major increases in the money supply from the financial crisis back to 2008, and when the market was still not doing good for a long period of time, they increased the money supply fairly rapidly, and the thought was like, maybe we actually can have real low inflation and a strong currency. And they tried it, and it didn't work. Like credit froze up because this is an experiment, right? If you go back to the historical of this money supply, it's like these are completely unprecedented levels. Okay, you go back to the beginning of this in 1970, and like the U.S. Federal Reserve, like the money supply is not even $1 trillion. The entire money supply is not even $1 trillion, right? That's like the deficit of the U.S. in 1 quarter in 3 months. It's just the deficit in 3. It's kind of fun, and this is not population growth, right? Because population growth is like hovers around 1%, a little over 1% in both Canada and the U.S. in this time. It's just the creation, the dilution of the money supply. So it's just going from we always have the Canadian dollar and the Zimbabwe dollar. It's just going closer from this to this, right? It's how do they finance those operations? Government can't really give you things for nothing. They just have to devalue your savings and devalue your future earning power. Like that's how it's paid for with deficit spending. Okay. And so they tried that experiment, that quantitative tightening experiment, and it literally crashed the credit markets, and they had to step in on an emergency basis. Now, going back, we actually don't know if that intervention was effective or not. We don't know because they started that intervention in, let's call it Q4 of 2019.
Yeah.
And they injected that liquidity, but, come March, they injected a whole pile of liquidity for another reason. But how much of this liquidity, would have been necessary anyways just to solve this? We don't know.
No, we'll never know.
We'll never know, right? And so this is why we're going into an unprecedented time, because now they've tightened up the system much tighter. They've decreased the monetary base much tighter than has ever been done before. And they,
Yeah, well, you look at that curve, they're going down. Like we're at a high, and then like what's the difference between that peak to trough there?
8.9 trillion to 6.5 trillion. So down by $3.3 trillion. Remember last time they just tried 700 billion and it crashed the credit market. They tried 700 billion and it crashed the credit. So they tried 700 billion over the course of, let's call it like 3 years. Okay. It didn't work, right? Now it came after a very long period where it was flat. So they it was all intents and purposes, it was flat from 2014 to 2018, and then they tried to decrease it, and basically something broke. The old thing is something broke, and they injected liquidity. Okay, so now we know that we're headed. When you look at the repo operations, they're headed towards those same levels, and I would say that $100 billion level is kind of like the stop loss, right? And it's kind of interesting that this happens at the end of the quarter. Like, why does that spike at the end of the quarter? My understanding of the plumbing behind the system is the banks can lend unofficially back and forth to each other in between their reporting periods. But at the end of their reporting periods, at the end of the quarter, at the end of the fiscal year, which a lot of them will have December, they have to be in compliant assets. So they can't have kind of ad hoc loans between each other. They actually have to be in compliant products, whether they're holding U.S. Treasuries or facilities authorized by the Federal Reserve. So you kind of don't know mid-quarter. So it'll be very, very interesting to see where, in the first 2 weeks of January, where this number is that will, it'll give us some basis point, like how close are we to that 100 billion, if they're 100 billion, if the U.S. banking system is 100 billion into their overdraft, just like they were in 2019 when the credit markets started to seize up, how close are they to that limit? And I think they recognize that. They recognize that because that was the U.S. Federal Reserve, Jerome Powell saying, we're going to be buying U.S. Treasuries again, right? Quantitative is, but it's not quantitative easing. Trust us, it's not quantitative. We're just expanding. It's not, even though we're expanding. So call it whatever you want. They're expanding, and I think they know that that's their stress point. I think they can see that level, that $100 billion level. They know that it broke there last time, and I think that's a guardrail, right? Because the U.S. The Federal Reserve effectively has like 3 mandates. Okay, everyone talks about stable prices and employment, but it's basically a functioning bond market too. Mm-hmm. So they have all 3 mandates. That's an issue, right? And so this is an unprecedented time because this is I think if you imagine a really big airplane and a really small runway, and they're trying to land that plane on that really small runway, and it's possible that they land that plane, but it's probably, if you break it into a third, and a third, a third of 33% of the time they'll probably landed on that runway, but 66% of the time they'll probably pull up short or too far. Okay. Yeah. And so if they pull up short, you're going to have credit markets seizing up. You're going to have asset prices pull back. And if they go too fast, you're going to have asset prices, you're going to have liquidity become available really quickly and asset prices spike. And I would suggest that they're largely guessing on this because this isn't the commercial airport that they pull in all the time. They have one example of ever doing it, and it got cut short by COVID. So they don't even really know how effective that intervention was last time because they didn't have enough time for it to play out. Mm-hmm. And if you just go back through history, there are no other similar